All right, let's dive into one of the biggest, most shocking corporate meltdowns in history, the story of Enron. I mean, this is a tale of massive success, right? But it was all built on a foundation of lies. And we're going to pull back the curtain and see exactly how this corporate giant just crumbled into dust.
Okay, check out this number. $90.75. Back in the year 2000, that was the price of a single share of Enron stock at its absolute peak. This wasn't just a number, It was a symbol. It meant you were looking at a titan of industry, a company that everyone, and I mean everyone, thought was the future of American innovation. They were the darling of Wall Street.
Now fast forward just over a year. That same share, it was worth 26 cents. We're not just talking about a bad day on the market here. This was a catastrophic, lightning-fast collapse. A company that seemed absolutely invincible had basically just vanished.
So, how does that even happen? How does one of the biggest, most celebrated companies in America just disappear? That's the huge question we're going to unpack right now. Let's get into it. A titan turns to dust. The story of one of history's most infamous corporate collapses. To really get how a titan like this falls apart, you first have to understand the incredible image it projected to the world. Before it all came crashing down, Enron looked completely untouchable. All right, next up, the darling of Wall Street, building the facade of innovation. So let's rewind and look at this glittering, perfect image Enron showed everyone. It was, honestly, a masterpiece of public relations, but it was all built on a foundation of sand. Okay, so here's the quick backstory. Enron gets its start in 1985 from a merger of a couple of gas companies, but it grew at this absolutely insane pace. You had leaders like Kenneth Lay and Jeffrey Skilling, who took it from just a regular pipeline company and turned it into this massive, complex energy trading giant. They were buying and selling contracts for things like electricity and natural gas. By the year 2000, they weren't just big. They were seen as the model for what a modern company should be.
And listen, it wasn't just them saying it. The business press was obsessed with them. This quote pretty much sums it up. This carefully crafted image, this idea that they were a tech-driven, forward-thinking innovator, it worked like a charm. Investors felt totally secure, and that sent the stock price just soaring. This public image, it was the fuel for the whole fire.
So how did they hide $1 billion? Let's get into the two big tricks behind the deception. This is really the core of the whole mystery. How did they keep this amazing illusion of success going for so long? Well, it all came down to some incredibly clever and totally fraudulent accounting. We're going to break down the two main tricks they used to pull it all off.
Yep. The secret to Enron's so-called success really boiled down to two clever accounting tricks. Behind all the talk about innovation and the future, this is what was really powering those unbelievable profits. Okay, trick number one was something called a special purpose entity, or an SPE. The easiest way to think about this is like a magic box. Seriously. Enron could just create one of these shell companies, take all its massive, ugly debts, and just stuff them inside this box. And just like that, they disappear from Enron's own financial records.
And here's how they did it. It was a really simple three-step process. First, they create a shell company. Step two, they move billions and billions of dollars in debt and liabilities into that shell. And step three, Enron's own books look squeaky clean and incredibly profitable. It was a perfect illusion of financial strength.
The second trick is an accounting method called mark-to-market. Now this one is wild. Imagine you're a farmer and you decide to sell your entire future harvest before you've even planted a single seed. And then you book all that potential profit as if you have it in your bank account today. That is basically what Enron was doing. They booked estimated, hoped-for future profits as actual current income the second a deal was signed. They were counting money they didn't have and, in many cases, would never actually see.
And this comparison just lays it all out, right? A normal, honest company books profit when the cash actually comes in the door. Real money. But Enron's profit, that was based on these wildly optimistic guesses about how much money a deal might make in the future. This little trick basically turned their financial statements into works of science fiction, and it's how they were able to report these record-breaking earnings quarter after quarter.
All right, new section, the culture of deceit, the rot from within. Because, these financial tricks, they were just the tools. They could only exist in the first place because the corporate culture at Enron was so toxic. The rot didn't start on a balance sheet. It started right at the top, in the boardroom.
So what was it like inside Enron? Honestly, it sounds brutal. The CEO, Jeffrey Skilling, pushed this super competitive system they called rank and yank. Basically, employees were constantly graded against each other, and the people at the bottom of the list just got fired. This created this insane pressure to hit these impossible short-term goals, and it rewarded people for being aggressive and secretive. All while this was happening, the top executives were quietly cashing out millions and millions in stock options because they knew the whole thing was a house of cards.
So now we come to a legacy of reform, the reckoning and its aftermath. Because a culture this toxic and a fraud this big, well, couldn't last forever. Now we're going to see how it all came crashing down and how the fallout literally changed the rules for every corporation in America.
And when the end came, man, it came fast. This all went down in 2001. In August, CEO Jeffrey Skilling just abruptly resigns. That got people suspicious. Then by October, the company finally admits it had overstated its earnings by billions. That's when the panic started. Confidence just evaporated overnight. And on December 2nd, Enron filed for what was, at the time, the largest corporate bankruptcy in U.S. history.
And the human cost here was just devastating. You had thousands of employees who didn't just lose their jobs, they lost their entire retirement savings because it was all tied up in Enron stock that was now completely worthless. Investors lost billions. The scandal was so huge, it even brought down their accounting firm, Arthur Andersen, which was one of the top 5 biggest accounting firms in the entire world. Just gone.
The fallout was so massive, so widespread, that the U.S. government had to step in. This whole disaster exposed these huge gaping holes in financial regulation, and Washington knew they had to do something.
And this is what they did. Congress passed the Sarbanes-Oxley Act in 2002. This was a landmark piece of legislation designed specifically to stop another Enron from ever happening again. It put in place much stricter rules for corporate accountability, tougher auditing standards, and new protections to shield investors from this kind of massive fraud.
So when you look back at it all, the soaring stock price, the glowing magazine covers, that reputation for being brilliant innovators, you're left with one single stark conclusion. It was all built on lies.
At the end of the day, Enron is this incredibly powerful cautionary tale, right? It's all about the need for transparency, accountability, and just basic ethics. The lesson was crystal clear. But it makes you wonder, looking at the complexity of our world today with all its moving parts, are we still listening?